Linde is head of Asia Equity Strategy at HSBC. Herald, it's always a pleasure to welcome you on the program here on CNBC-TV18. Thanks very much for your time. Where do we start, Herald? What part of the market should we poke at first? Should we start with what's happening with yields? 30 basis point rally, 5% hit, on Monday, back at about 4.82. What's your sense? Where are we headed on the US 10-year?
I think you're right. We have to start about yields. I think a lot of what's driving markets at the moment has got to do with bond yields. There are, of course, geopolitical issues. We see gold move. We see oil move. That is related to that to a certain extent. But the overarching factor is what happened with bond yields. Now, they've gone up, as you highlighted. They hit 5 early this week. They've traced back now. We've also seen that the Fed has starting to shift its language. It is a bit worried maybe about the increase in yields that we've seen. And I think one of them mentioned that the tightening in financial markets or the increase in bond yields is already equivalent to a rate increase. So they shifted their language a bit that they might move towards a halt. We'll have to find out if that's the case. But I think this is really driving it. So we've seen the weakness in the markets as bond yields rising, and now you see this bounce back. What is interesting is also flows in the region. Maybe we could talk about it in a second, but how people are repositioning on India. But this is really what we need to look at. And I'll be very interested to see what the Fed is going to do and how they're going to deal with this, because they can raise interest rates further, but the market is now doing the job for them. Bond yields have gone up. That means your mortgage rates should go up, right? And credit card rates go up in the US. So that tightening should start to filter through and should start to make them a little bit worried about what the economic consequences of this are going to be.
Herald, hi, good morning, and thanks for being with us. So what about a market like India? Because we have lost over 500 points on the Nifty in the last 5 days alone. It's been pretty ferocious, the kind of selling pressure. As the risk aversion towards equities increases globally, would you take money off the table from a market like India?
So actually I don't. But the story for next year is going to be how these bond yields are going to decline. Maybe this is going to be a slow process of a gradual decline. The problem is that we can't rely, and this is what we've learned over the last, say, 6, 9 months or 12 months even, we can't rely on the global conditions for Asian markets to perform. So we need to look at what in Asia is locally strong enough to offset the story of inflation and bond yields in the US, which is clearly negative for us. The stronger dollar is negative for us. So where are there the positive stories? And India fits into that. Now, there's a counter issue to a certain extent here, because if bond yields really start to decline, and they don't have to fall a lot, the Chinese markets will respond more positive to this. And what we see now, and this is quite interesting, is that emerging market funds, so the kind of the global funds that are in Asia, but not the Asian portfolio manager, the emerging market funds, they have sold a little bit of India and moved that into China in the last month or so. Asian dedicated funds, they have stayed with India. Do I think we should be selling India or should we be buying India? I think India is one of the great stories for the next couple of years across the region. I would like to buy when the valuations are more attractive and when there's weakness in the market. We've seen that come through. So I'm not overly worried about this particular adjustment. I think this has really got to do with global bond yields and not so much about the growth story in India, which seemingly is still on track.
Hi, Herald. Good morning. And you've maintained that in the past, right? If there is weakness in the Indian markets, you look to get in because you believe there's a structural story that's playing out here in India. But give us, your outlook on a couple of factors. You said valuations on the Indian markets. What is that calling for? Is it calling for a bit of a contract? I mean, maybe a cut of 5% odd on the index? What would that be? At what level does the Indian markets become, okay on the valuation parameter? And also in the past, I think you've spoken about the consumer space, banking names that you like here in India. Run us through what you like.
Yeah. Now, first on how I would look at how much downside there could be in markets. That's really a question for me. How much can these bond yields go higher? And can they go from 5 to 6 to 7? Maybe they do. But the data at the moment tells us that probably it can't increase a hell of a lot beyond the 5 of where we are at the moment, right? Some people in the markets have come out and said, we're covering our shorts here. I think you mentioned it earlier as well. We see now that the Fed is changing its language, says, okay, we've seen quite a substantial increase in these bond yields already. Maybe that implies that actually there's already a kind of a rate hike priced in and these sort of things. So I think if we assume that for the moment, unless new data comes out, we can't really go beyond 5. I don't think there's a hell of a lot of downside in markets in general and in India either. If earnings would come through very weak in India, then I would say, oh, that's a problem, because then we have global headwinds and local headwinds. But at the moment, so far from what I've seen, the earnings forecast for this year, but also for next calendar year, still look pretty intact in India. You're talking about something like 16-17% or so next year. So I'm not overly worried about that. So I think the downside cannot be a hell of a lot from current levels.
Okay, and what do you like?
The second question you had was, hey, what do you look at in India? So it's the consumer, banks, and then you go back and say, what are the structural stories in India, right? And that is formal retail gains market share over informal retail. Private banks probably continue to gain market share over some of the public banks. It is that your banking system has been cleaned up and credit is flowing. So it's these sort of stories where I would hang my head on. So there would be selected retailers, there would be selected consumer names, and the banks. I would be probably a little bit more careful with some of the exporters. So I'm thinking about pharma has done very well, but that's really very often a kind of a product issue as well, and IT. Because if we assume that the US can't really hold on to the strength in next year, at some point in time, those sectors will probably roll over a bit.
Okay. Herald, sort of wrapping up this with a simple question. Do we want bond yields, do we want a steep fall in bond yields? Because, I mean, as you mentioned, Bill Ackman saying we've covered a bond shorts, right? There's too much risk in the world to be short bonds. He's expecting a recession in the fourth quarter. So, we're in a juncture where bonds going up, or yields going down is essentially going to be an indicator of that. And do we want that, or do we want the situation that we are in right now, which is the economy is strong, yields stay high but not maybe too high? What's your view?
My view is that we don't want these bond yields to come off too quickly. Although it is a positive for Asian equities, that in itself could create problems or could be a signal that there is a problem. What we like is a gradual decline in growth in the US. So no worries about a deep recession, but kind of below trend growth for a little bit of time. That would be an ideal situation. That would mean that these bond yields could gradually go from 5 to 4.8, maybe moving towards 4-ish, maybe below 4 over the course of the next 6-9 months or something like that. Now, that would be a nice gradual decline. That would be positive for Asian equities. But a sharp decline would either indicate that the economy is very weak in the US, that's bad for us, or could in itself create disturbances because the market might be wrong positioned and you get all kinds of flows associated with that. So I like gradual adjustments if it comes to that.
All right, Herald, we'll let you go on that note. Thanks a lot for joining in. And I think some sanity, is required at this, or some sane advice is required at this point in time, considering there's a sell-off across the globe. But you're not too worried about a market like India, you say. Thanks a lot for joining in.